I want to show you a quick, easy legal trick to get your credit score higher right before you apply for a loan. If it's a DSCR, fix and flip, or just even a line of credit, by picking this date to pay off your credit cards or pay down your credit cards. So you could get a better credit score. You could get the better terms, the rates, everything you need just to make this easier and more profitable. So let's dive in and look at exactly what day we're talking about, how to make this work, and how to put more money in your pocket. That's what we're all about, is making sure you know the tricks of the trade in the finance world to get the most out of everything you do. So it's going to be all based around a credit card statement. I'm going to show you 3 different credit card statements because the dates are different for each one. And they're unique for you too. So we want to make sure, we're looking at Chase and American Express and Capital One, just so you can see everything that's involved. Don't worry, it's easy. But I want to make sure if you're using one or the other, you know exactly where to look. So let's start with why we're doing this. We're in the business. We're in businesses that require a lot of credit card usage. And credit card usage affects the scores. That affects your score as you're going through a flip, where you're going through just regular business, you're racking up credit card debt, bills, and those charges are affecting your score. So not every time, but any time that you're looking to refinance or apply for a new loan, you need to make sure your credit score is maximized. When we're looking at credit scores, at least from the bank financing perspective, we want to make sure we're targeting credit scores that are above 720, because this is going to get you the better LTVs, which means more money from the loan, less money out of your pocket, more money from the lender. It's going to get you a better rate, better fees, closing, and maybe even just get approved for the loan. We want to make sure you're in the best position to get the loan at the best terms that will make you succeed and keep more money in your pocket. So if we look at this example here that we have on the screen, we're looking to get from the mid 6s all the way into the 720s. And like I said before, the reason why is if you look at a matrix, this is just an example of a matrix, even though in most they're computerized now. What you're going to see is the higher the score, the lower the rates, because they're not going to add any extra fees or cost to the loans. That's what these little numbers are, as you see here, from anywhere from 0.125 at 760 at 60%, all the way up to 1.125 if you're at 680. So that's what they're going to add to your rates depending on your LTV. And if you don't have the score and you're at a certain loan to value, they're not even going to offer you the loan. So we want to make sure you're in the best position to maximize your credit score so you can get the best terms. And that's what we're going to go through here today on fixing your usage before you apply. So first of all, let's go through. I'm going to show you an example here of what usage is and how FICO and everyone uses usage when they're determining your credit score. So usage is 30% of your credit score. 35% is making payments. So if you're not making payments on time, the usage is not going to help that much. If you're having problems struggling with your credit score is a little bit low, check below. We have some great information, great referrals to get you back on track so you can get your credit score up. Because if you don't have great credit, good credit, you want to make sure you do, because in real estate investing or in business alone, having the best financing, cheaper, easier financing is important. And the number one thing is you need that credit score. So let's figure out ways to get your credit score on track so you get the best terms out there. But today we're talking about usage, the 30%, the one thing that most of us, including us, we use our credit cards, we run up balances, we have to pay them down. If we're looking for, new loans, anything, we have to make sure it is in line. So we're talking about the usage because it is a problem with at least half, probably more like 60, 70% of the borrowers we talk to. So first of all, what is usage? Usage is the amounts on your statement that get reported to the credit bureaus compared to your available balances. So here's an example. You have a credit card that has an available balance of $10,000. On your statement, when it reports to the credit bureaus, because that's when they calculate your usage and use it for your credit score, let's just say you have a balance of $5,000. So in this case, you have a usage of 50%. 5,000 divided by 10,000 is a usage of 50%. And our goal here is to get that usage into a level that the credit bureaus like. Really what we're targeting here is anything below 30% and not at 0% in either. So when the statement hits, the amount that owed is not the amount you're accruing interest on, but when the statement shows your balance and it's reported to the credit bureaus, we want to show a balance on the statement of less than 30% on the overall portfolio of cards. So if you have 2 cards, 3 cards, we want to make sure the total that's reporting on your personal credit is at or below 29%. Typically, even if you're at less than 10%, it helps. But what we've seen, as long as you're under 29%, you're going to raise your score. You're going to get into the good credit that you're looking for. Once again, depending on the rest of your credit. But if it's just based on usage, everything else is good. Your mix, you're paying on time. Manipulating or working with your usage before it gets reported to the credit bureaus is a way for us to raise that score. When we apply, we're going to get the better terms, easier qualifying, everything that we're looking for. Remember the one thing when we're talking about credit score and usage, it's all based on credit that's reported on your personal credit. So that's personal credit cards. It's also business credit cards like Capital One, Discover. Most of those, will also report to your credit. So check out your credit, go to Credit Karma, go to My Credit Score, check your credit, see which ones are reporting on your credit. Those are the ones we're going to focus on. If it's a business card that's not reporting, we're not going to worry about that. That brings up another point as we're going through this. If you don't have business cards that are not reporting, it's time to start migrating over to business credit cards because it just makes life so much easier. You're not going to have to go through this every time you're looking to apply. And it's not going to affect you personally, like in your, debt to income ratio, if you're applying for a home mortgage or a car or anything on that side, because a business credit card is not going to report. It is something you should look at. We've identified some great business credit cards, even ones with 0%. Link below. If you're looking at those, it's time to start migrating over to business credit cards versus personal. That way you can eliminate this whole process before you're applying for your next loan. So let's dive in and look at a couple statements. I have 3 different cards we're going to look at. They're my cards. There are business cards. So we're going to look at a Capital One because I do have a Capital One that's reporting. And I do go through this whole process just because I love the cash. So let's dive in and look at a few things in these credit reports, starting with the usage and how they calculate usage. Number one, as you can see on this statement, we have a current balance. This is the balance that is reported to the credit bureaus, a little over $3,888. And down here, we have a credit limit of $50,000. So on this card, to figure out the usage, we're going to divide the $3,888 by $50,000 to get our usage on this card. But more important, what I'm going to do is I'm going to add up all the cards that report on my personal credit. I'm going to do an Excel spreadsheet, and I'm going to put all the credit limits on one column, and I'm going to show you an example here of where I'm going to take 3 different cards that's reporting on my credit. I'm going to find the available credit limit, like on the Capital One. You can see the credit limit right here, the $50,000. On the American Express, it is right on the bottom right-hand side where it says credit limit. On the Chase card, it is in the account summary where it shows, in this case, under the second line where it says revolving credit limit. Those are your credit limits for each card. Now we're going to log on, look at our accounts and see what the balance is currently so we can find out where our usage level is now before that date that we want to pay them off. So we're going to take that Excel spreadsheet, we're going to add up our current available credit and how much we have outstanding today by going on and logging into your account so you know exactly what it is. We're going to add up all the available credit, quick calculation, and then we're going to add up all the amounts outstanding. And then we're going to divide the amounts or the balances you have by the available credit. And we're going to see what our usage rate is. Remember, ideally, our usage rate, we want to be at 29% or below. The lower, the better. We do not want to show a 0 because for some reason, the credit bureaus do not want to see on statements 0 balances. They want to see some kind of usage because they want to keep giving you credit. That's the game that they're playing. What we have to understand is the tricks to succeed in this, which is when we're applying, we want to make sure our statement balances reflect a good usage. So let's run through an example here. I have a Capital One, $5,000 in available credit. I have a Chase that has $5,000 and I have an Amex that has $10,000. I go through, I add those up. I have $20,000 available credit. And let's say I go online and I'm looking today and my balances are $3,000 on the Capital One, $4,000 on the Chase, and $7,500 on the American Express. Add those all up, it's $14,500. I divide the 14,500 by the 20,000, and I see my usage ratio is 0.725 or 72%. That's not a good ratio, especially when I'm applying for new credit. So I want to make sure that comes down. So what I'm going to do is target paying these off before the statement cutoff date. Remember, the credit bureaus are going to use a statement balance to calculate your usage. So if we could manipulate pay down the statement balance that's going to be reflected on the credit reports, that's going to allow us to get the usage rate that we want in this particular case. Just remember, like I said, this is a way to legally make sure your usage is helping you and not hurting you, but it's not a thing you have to do every time your credit card comes out. This is only when you're applying for that new loan, the new fix and flip, you're getting, a bank loan or whatever. You want to show your usage down. So we're going to look at those numbers and where do we find when they're going to report. Everyone's going to be different. So the closing date is the last day that they're going to take any charges and add to the statement. So we want to go into here, find out when your statement closing date is, because it's going to be different for every card, different for every person. So make sure you're looking at your information. The information I'm giving you is from our cards. So check your cards and find out when your closing date is. On the Chase, as you can see, it's under new balance and it's opening and closing date. Now, if we look at our Capital One, which has up in the right-hand corner, it has our closing date, which is, in this case, it's January 11th. So that's the closing date for Capital One. It shows up in the right-hand corner in our statement. You have to find it in online or on your statements. American Express is now on the left side under our name. It shows the closing date of this, and it also shows the closing date of the next statement. Now, our goal here is to pay down your balances to get to 29% or below. So in our example, on the Excel spreadsheet, we were at 72.5%. So I'm going to play with the numbers. I'm going to play with the available cash I have to pay these down early. Because remember, what's going to happen here is I'm going to get a better FICO. So on a DSCR loan, maybe I get an extra point off, half a point off a 30-year mortgage by just doing this little trick this one time, paying them down to have benefits for, for the next 30 years. So I'm going to pay $2,000 on the Capital One, leaving $1,000. I'm going to pay the whole Chase off of $4,000. And the Amex, which I had a balance of $7,500, I'm going to pay $5,000 down. Now, instead of $14,500 in balances, when they report my balances to the credit bureaus based on my statements, it's going to show $3,500 total, or about 17.5% usage. Remember, they want to see some usage, and they want to see it under the moderate level, which is 30%, so 29 and below. Now, when we're looking for the next loan, the next DSCR, business credit card, business line of credit, whatever it is, and we're looking at our usage and it's affecting us, and it affects a lot of us in this industry and most industries, we're going to go in and we're going to pay these down. And where does this money come from? We talk about this, and we've talked about it before, your money bucket, the money that you need to keep projects going, keep them going at super speed. So it is lines of credit that are not on your personal credit. We're talking about HELOCs on your non-owners, or OPM, real people's money out there where you could take this money, or just your savings. Every time you're doing a project, there's going to be some that the lender gives you, and there's going to be monies that you need also. If it's down payment, if it's your monthly payments, if it's, just pre-funding the escrow, whatever it is, you're going to have to make sure you have money buckets available. If you want to learn about money buckets and what you need, look below. We have a link. We go over money buckets and how to properly fund and set yourself up to get the best, easiest, cheapest financing out there. So that's where this money's going to have to come from. You're going to have to either have it in your account, which you should never have money in your account earning nothing if you have credit cards, especially if you're paying 24 to 29%. Let's wrap this up. So we're looking at when you apply for new credit, what do you do, especially when you have cards and balances showing up in your personal credit that's affecting your usage? Number one, understand what the proper usage is. The proper usage is below 30% that shows on your statement. Remember, the statement balance is what the credit bureaus use to calculate your usage. Now, if you're looking to apply for new credit, you want to make sure that usage is in line. Typically, if you're not applying, it doesn't matter. When the next flip hits, pays off, you could, wipe those balances off. But when you're applying for any kind of credit, you want to make sure your usage is in line. And you do that by going out and looking at each credit that's reporting on your personal credit, finding out what days the statement closes so you can pay them off a day or two earlier to make sure your balances are in line with that below 30%, higher than 1%. You want to keep some kind of balance on there. This allows you to raise your credit score, get better rates, get better terms, meaning typically lower fees, higher loan to values, meaning they're going to give you more of their money to use instead of having to come up with your own money. If you don't want this to be an issue in the future and you're looking to migrate over to business cards, check it out. We have a list of business credit cards that we recommend for investors. And please subscribe to our channel, because our whole goal here is to make sure you spend less, make the most, and enjoy real estate investing.